The impact of a weakening US dollar on the Singaporean economy. Well, in the past 10 years, the US dollar has been depreciating steadily. The value of the US dollar has been falling steadily, with its exchange rate with Singapore falling from $1.79 in 2001 to $1.28 in 2011. This can be attributed to the weakening United States economy and the United States growing debt. In order to save the major players of the United States industry from bankruptcy, the government of the US are selling more bonds to fund for its stimulus and bailout packages. As Treasury note and bond yields increase, so do the interest rates on fixed-rate mortgages. So what this means is it is more expensive to buy a home, and thus demand for homes decrease, and of course the prices too. This, then, has a negative impact on the economy. It can slow down GDP growth, what is otherwise known as gross domestic product growth. The dollar becomes less appealing to investors and depreciates as they find they are better off purchasing bonds, stocks, and assets from other countries with a stronger economy and a more stable debt. This is because the debts from these other countries are less likely to be defaulted. Since the relative investment prospects abroad is now better than the US, demand for the US dollars will actually fall and the supply will rise. The value of the US dollars thus shift downwards to the new market equilibrium, as can be seen from the graph above, that is, the point which is combining D2 and S2. Now we will go into the thing that we will be discussing for tonight, that is, the impacts of the US dollar on the Singaporean economy. Well, looking first at our first stimulus, the weakening US dollar will cause the value of goods from the US to decrease. Goods imported to Singapore from the US are now relatively cheaper. Thus, there will be an increase in demand for imported goods in Singapore. This is especially significant since the US is the third major trading partner with Singapore. Well, in this particular stimulus, there are two impacts: the internal economy of Singapore and the external economy that will affect Singapore too. Well, firstly, for the internal economy, that is, the domestic economy of Singapore, the cost of imported goods from the US will decrease, thus decreasing the prices of factors of production. This applies to raw material that we import as materials to manufacture into other goods. Some imported goods from the US are aircraft and parts, ICs and semiconductors, printed circuit boards assembled, and other computer parts. This causes the aggregate supply to shift downwards from AS0 to AS1, as can be seen from the graph above. As a result, the real national income shifts from YF0 to YF1, signifying a growth in the economy. This also causes the general price level to drop. Since more laborers will be required to handle the increase in factors of production, employment rate in Singapore will rise. And now we look at the external economy. Due to the decreased prices of imports from the US, Singaporeans might substitute domestic goods for imported goods. At the same time, goods that the US imports from Singapore would now relatively be more expensive, and it will cut down these imported goods. These goods are computers, disk drives, printers, and peripherals, and printed circuit boards assembled. The net export for Singapore thus decreases, causing the aggregate demand to shift to the left. This is assuming that the price elasticity of imports and exports is greater than 1. The balance of trade will be negatively affected, implicating the balance of payment as well. This will cause the current account to move into deficit. There will be less demand for Singapore dollars, resulting in currency depreciation. Graph 3, that is the graph above, shows the depreciation of the value of Singapore dollars due to the drop in demand from D0 to D1. In conclusion, macroeconomics' impact on the Singapore economy can either contract or expand the real national income. It depends on the magnitude of the shift of the AD or the AS curve. In Singapore context, it is more probable that the shift of the ES curve is greater because, in actual fact, we rely on the US for a large proportion of imports of raw materials for producing other goods. The Singapore exports to the US are less significant, as Singapore is not the sole supplier for such exported goods. Now, we look at the microeconomic impact. The first stimulus that we can think of is that investors are interested in protecting the value of their capital. So, instead of owning actual dollars, they prefer to own assets. This is why the demand for materials, oil, and agricultural commodities is firm. By switching from cash to finite resources, investors want to ensure that they will, at the very least, be protected from the erosion of the currency. Most of the demand is not for the real commodities, but for future contracts. By borrowing money, they can buy even more of such investment vehicles than they normally would or should. The higher demand for commodities results in an increasing price, in US dollars that is. Since they buy as the US dollar weakens, they will get back more dollars when they sell, although with the potential depreciation. And so, as can be seen from the graph above, graph 4, as the quantity demanded for commodities surges, the price of these goods also increases. This is especially so in goods like gems, as such goods are very price elastic and are very limited in supply. So what graph 4 shows is an increase in demand for commodities from D0 or D0 to D1. The price of commodities thus increases from P0 or P0 to P1. Due to the unreliability of the US dollar, there is an increase in demand for commodities. This will cause a continual increase in price in such commodities. Other than goods like gems, the price of oil also increases. The increase in oil prices become a burden to the drivers of Singapore, as they will find it harder to afford driving as oil prices continue to increase. There are also food commodities which will greatly impact all Singaporeans. In fact, it will have a global effect since we are already facing a shortage in food supply for the growing population.